Wall Street Week with Louis Rukeyser. Brought to you by this and other public television stations. And by grants from the Hilton Hotels Corporation, America's business address. And its subsidiary, Conrad International Hotels, the world's business address. Prudential Bache Securities. Prudential Bache's total financial planning can help the American dream happen. And the Sperry Corporation, computer-based information systems for business, industry, government, and defense. Produced Friday, June 22. Our panelists are Frank Cappiello, Carter Randall, and Julius Westheimer. Tonight's special guest is Dave H. Williams, Chairman, Alliance Capital Management Corporation.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. What a difference a week makes. Okay, I may not be Tony Bennett, even in the week the cable cars started rolling again up the hills of San Francisco. But you've got to admit that the stock market has been having some lyrical ups and downs of its own. 7 nights ago, the music was suitable for funerals. The Dow Jones Industrial Average had taken its biggest one-week hit since 1979, off more than 44 points to a 16-month low. This week, though, no more dirges. Just when you thought it wasn't safe to go into the water, the Dow turned out to be not a shark, but a mermaid, splashing and singing like Daryl Hannah, to a gain of, you guessed it, more than 44 points. If I didn't know that they were all very wise and shrewd people in Wall Street, I'd have to conclude that the place was populated by a bunch of nuts. Gilbert and Sullivan, where are you when we need you? And why did the market turn so trippingly on a slightly tarnished dime? No reason special. The economy not only continued super strong, which perversely is supposed to worry Wall Street, the economy was looking even stronger. The Commerce Department announced that growth in the first 3 months of this year, which had previously been estimated at a red-hot 8.8% rate, was actually a white-hot 9.7%. While the first word on the second quarter, when all the wise men were predicting massive cooling, was that we were still booming along at a torrid 5.7% pace. The bond market didn't much like that. The bond market doesn't much like anything these days. But the stock market shrugged it off and kept on jiving. The slowdown that is supposed to produce some moderation of interest rates is plainly elusive. The nation's factories are at their busiest in more than 4 years. Consumers are spending at a rate that would shame a drunken sailor. The Federal Reserve Board is pumping away at an election year pace that has now exceeded even its own generous targets. Housing starts, while off a bit in May, were still pouring out at a hefty rate of close to 1.8 million units a year. And for those wondering if it's all about to stop next month, the answer seems to be clearly no. New factory orders for durable goods rose another 3.3% in May. From a political point of view, it was all lovely news for Ronald Reagan, who could also point to a notably subdued performance on inflation, at least for now, and possibly disappointing for those who had fervently hoped to portray him as the architect of bottomless depression. Financially, though, it was something of a puzzler to see stocks rebounding strongly despite another record deficit in the balance of trade, interest rates so firm and firming that the dollar hit record highs against the British pound and the Canadian dollar, not to mention some non-English speaking currencies, and some other signs of technical fatigue in the market. Oh, well, there may be some lunatic hard at work this very moment composing an entirely different song for next week. Stay tuned, and keep on strumming. We tonight will talk with a major investor who has had major success by ignoring these short-term panics and seeking something of more enduring value. But before we learn about those verities, let's visit the asylum. The Dow Jones Industrial Average turned in a mirror image of its performance the previous week, though it was churning a bit on enormous volume on Thursday and Friday. The week's trading was the busiest since February, as the Dow gained more than 44 points to close at 1131.07, almost exactly where it was 2 weeks ago. It was primarily a blue chip rebound, though. While the other indexes all gained, most picked up less than they had lost the previous week. Meanwhile, our elves, who have been saying bye since May 4th, have seen their technical market index slip a notch to a still bullish +3. The elves don't have perfect pitch either. Precious metals squeaked out tiny gains for the week, less than $2 an ounce for gold and just a dime for silver. Meanwhile, those who hope the market has bottomed still have to contend with such technical disappointments as a relatively weak lead of advances over declines and an overly rapid resurgence of optimism, evidenced by such figures as a decline in short selling. Frank Caprio, does any of that bother you?
Not the short selling. I think we are making a bottom. We're always seeking bottoms, Lou.
What do you mean making a bottom? We're up 44 points. Did we make it?
No, we made a bottom in the 1100 area. That's what I'm saying, in the 1080 to 1100 area. And I think every time the market has come down to that area, it's bounced off again. And particularly in the middle of this week on Wednesday, when we had that enormous 30-point swing and the market closed up on bad news. That is the strong economy that you mentioned should have frightened the market. The market didn't react to bad news. That's always a good sign.
So it's all straight up from here, is it?
No, it's not all.
Here again?
It's not all straight up. The pressure's off, and more than just off. There's a better tone to the market. We may have passed the barrier of fear and panic.
We keep hearing about end-of-quarter window dressing.
Well,
What's all that about?
Well, this is when institutions, major money managers, seek to spend their cash, so to speak, to show that they were smart enough to have bought stocks. Now, you can't tell when they bought stocks. If they bought them on the last day, they show them in their portfolio. We're getting some of that, too. There's always end-of-quarter window dressing going on when a market looks like it's about to turn up. But we may be in the beginning of the summer rally, and we may actually be in the beginning of the second phase of the market. One other point, Lou.
And we may not.
Please. One other point, Lou. I think it's curious. This week, the Hambrick and Quist Technology Index, which is an index of the smaller, highly volatile technology stocks, it's really been bad news for almost a year. This week, it had its biggest jump in some time. So we may have the technology stocks bottoming, which is another good sign.
It's more maize than I've ever heard from you. Usually you're a little more confident. Carterano, can you tell me what may happen?
Yes, Lou. Obviously, the so-called good news, bad news about the strength in the economy can be translated, as we've been saying right along, into sales, earnings, and dividends from corporations. And I think the market deserves a rally on that basis, or at least a few strong weeks. I must say, I don't see us hitting the new highs until that bond market gets strong and until interest rates come down a little bit. The news this week on inflation could mitigate the necessity for tight money policy on the part of the Fed.
What's the significance of the Argentina and overseas debt problems that we had this week?
Well, it's extremely significant, and I think people are very, very worried about it still, and they should be. A lot of banks have a lot of loans to foreign nations. I do not think there will be major problems with the major banks of this nation, but I do think that we're going to partially try to solve that problem by bringing the dollar down versus other currencies, and that would mean lower interest rates in this country.
That's one of the reasons the Fed may be so active on the high side.
That's why I think they will be, yes.
Julius Westheimer, you for a long while were quite pessimistic. Last time you were with us, you seem to have cheered up a bit. What do you think tonight?
Well, the market got down to about 1080 intraday a week and a half ago, which is a 200-point shellacking from its high. And I have the feeling that that is just about the low, unless we have some unexpected nightmare of an event like a military outbreak somewhere or President Reagan gets sick or something like that. But on the other hand, Lou, I don't see much that's going to push the market up to 1,300 or 1,400, like a lot of people say, because even though the news is good, Inflation is down, price-earnings ratios are down, book value ratios are conservative. I think the market knows most of this. I think a lot of this is factored into where we are. And furthermore, yields are so high, the temptation to go into Treasury notes at 13.10, for example, is compelling.
So you look for a sleepy summer.
I think the market will trade in a fairly narrow range on fairly heavy volume, and even though cash on the sidelines is very heavy institutionally, which it is, that's a two-edged sword too. That can go into fixed income. And in pension and profit-sharing funds, that's all tax-free. So there's a tremendous temptation there to take that cash and lock it up at these extraordinarily high rates.
You agree then with what Carter said, that the stock market can't really get moving until the bond market goes
I
up?
definitely do agree with Carter on that, yes.
All righty. In any event, gentlemen, it's time now to prove that Emily Post did not live in vain. Frank Cappiello Martin Fogarty of Indianapolis has a jewel of a question. A representative of a company selling gemstones has attached himself to me like a fly to flypaper, he writes. He maintains that gemstones represent about the best hedge against inflation, and he will not go away. Is he right in his assertion that gemstones are an almost infallible hedge against inflation?
Well, certainly nothing's infallible, though, but gemstones, precious gemstones, rubies, emeralds, and blue sapphires are good, excellent, I would say, hedges against inflation. But first of all, I don't believe inflation is going to be a problem near term. But if inflation does become a problem, then he should look into precious gemstones. Rubies have gone up 300% in the past 10 years. Emeralds have gone up more than that, and blue sapphires have equaled even those higher levels. So it seems to me that he's onto a good thing. The problem is you've got to buy them and hold them, and you've got to buy the best quality. And where he has to buy them becomes part of the problem. I'd beware of this guy. I would check out very carefully a salesman selling gemstones. Check the guy out with the American Gemological Institute. Check with the Better Business Bureau. In other words, Louis should leave no stone unturned in the search.
Oh, I like that.
You like that?
I'm glad you didn't give us a half-faceted answer. Carter Randall, James Wilbarger of Cashin, Oklahoma, says that as a small grain and livestock producer, he's certainly no stranger to market fluctuations. But he's concerned over an ad for so-called Ginnie Maes yielding 14.5% that warns that the securities might bring, quote, more or less than, unquote, the original cost when he sells them. He wonders what the expected range of such fluctuations would be, just what these securities are, and how their price is determined.
Well, all right, briefly, Lou, Ginnie Maes are notes issued by the Government National Mortgage Association, which are backed by residential mortgages. They sell on a so-called yield to maturity basis where there's an assumption as to the average life of the underlying mortgages. They will go up or down in price depending on going interest rates, just like any bond. How far up or how far down it can go that the assumption of the average life of the underlying mortgages is not necessarily correct. And also he's receiving dribs and drabs of amortizations as these mortgages pay down, so he's not getting quite the rate of return on his money he thinks he's getting.
All righty, Julius Westheimer, how would you respond to Kurt Wolf of Cincinnati, who says he is 82 years old and writes us as follows. My wife and I are getting quite concerned about the bond and stock markets, particularly the former. We would like to preserve our assets as best we can, but strictly without dangerous speculation. What is your opinion of gold and silver mining stocks, sometimes called penny stocks? We realize the income would be very low, but there must be a few which pay a little and have fair ratings and prospects. We are definitely not interested in the metal stocks per se.
Well, if the Wolves are concerned about the stock and bond markets and they don't want to speculate and they're in their 80s, I think they ought to stay away from penny stocks. Just because a stock is low price doesn't mean it's a good value. And there is no such thing as a free lunch, particularly mining stocks. I looked at some of those electrocardiograms and they are jumping all over the place. What I really think the Wolves ought to do are look at good, high-quality utilities that Argus might recommend. Or in Cincinnati, there's Procter & Gamble, a huge marketing company. It doesn't pay much income, but it's a blue chip. Or look at the Treasury notes that came out this week. I think they should be comfortable with their investments and stay away from penny stocks.
All right. Now, if you would like a penny for your thoughts, or just the cent of an actual profit, it won't cost you a nickel to write us, except for the stamp. Send your big and small money questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's find out which have been the best and the worst performers among the 30 stocks of the Dow Jones Industrial Average this past lackluster year, as we take one of our periodic looks at ups and downs. While the Dow itself has fallen about 9% over the last 12 months, the action of its individual components has been spread over a much wider range. The biggest gainer among the 30 Dow stocks since last June was General Foods, up 22%. Exxon was next with a 16% gain, followed by American Brands and Merck. Woolworth, with a slight 3% advance, rounds out the list of the year's relatively anemic best of the Dow stocks. Meanwhile, the Dow's 5 worst performers for the last 12 months have charged far more vigorously in a downhill direction. Best of the worst, 5th from last, was International Harvester, whose stock fell 25%. Sears and Union Carbide were next, both down by 29%, followed by Inco with a 34% loss. And the Dow's worst performer for the past year, apparently leaving it all at home, was American Express, down a sickening 41% and deserving no credit whatsoever. And where are we likely to find next year's big winners? For some thoughts on that, let's go over now and meet tonight's special guest, Dave H. Williams. Dave, welcome. We're pleased to have you with us.
Thank you, Lou.
Please.
Good evening.
Have a seat. Dave Williams is a modest man with an immodest job. As chairman of Alliance Capital Management, he runs the nation's largest independent pension fund advisor, which now manages about $18 billion. During his 7-year tenure at Alliance, Mr. Williams has seen those assets more than triple, thanks in large measure to a consistently superior investment performance. Though he is clearly near the top of his profession, he likes to attribute his success to looking at the world, as he puts it, from the bottom up. Dave, what does that mean?
Well, that means that we tend to put more reliance on analyzing individual companies and individual industries than, say, signing on to some economist's somewhat theoretical macro view of the world.
Does that mean that you ignore what you expect for the economy as a whole?
No, but we try to build a picture of it more from the bottom up, seeing what companies and businessmen are doing and forming our views from that.
What does that tell you about the overall economy now?
Well, in some respects, it coincides with the macro view. Namely, we do have a strong economic recovery underway, but perhaps the most important thing is inflation is just about non-existent.
You're not concerned, then, with the monetarists who say that the rate at which the Federal Reserve Board is producing money will produce inflation later on?
Well, I know that there are correlations in the past that always prove out in retrospect that there's a linkage between money and inflation, and certainly theory suggests that should be the case. But I am struck by the divergence of opinions of monetarists versus what I see happening in companies and industries.
Does that suggest to you that the stock market is going to have some more of this bull market?
Well, I think that's one of the things that's helping the stock market. The decline in inflation has certainly done a lot of good things for companies.
Dave, you heard our panelists. The question that people keep asking is why, with government bonds yielding 13.5%, 14%, should anybody buy stocks? What's your answer?
Well, it's hard to deny the attractiveness of bonds, and I think that bonds are very attractive. But the stock market may periodically kind of de-link from the interest rate gridlock in whose clutches it's been held, because there are some very good things at work for stocks. For example, the vastly improved quality of earnings, which are a result of the inflation decline.
You marshal so much money that you have to be buying an awful lot of stocks. Where in particular are you finding values now?
Well, we find them in a lot of places, as a matter of fact, which is, I think, a good sign that the market may be attractive. We find them in growth stocks. We find them in cyclical stocks.
What are some examples of the ones you like in both those categories?
Well, if you say growth stocks, probably the great growth industry of today, as we see it, is the media industry, ranging from publishers to broadcasters to information companies. There's a wide range of companies in that industry that I think are quite attractive.
Which ones do you like in particular?
Well, you could kind of go from one end of the spectrum, Dun & Bradstreet, which is probably undoubtedly the leading computer-based publisher of information, to Gannett, to Dow Jones, to American Broadcasting.
Then you said you also like some cyclical ones, those that go up and down with the economy.
Right.
What do you like there?
Well, it's kind of out of phase from a cyclical standpoint to like what are called early cycle stocks or consumer cyclical stocks, but I'm very struck by what appears to be cheapness amongst auto stocks, airlines, retailing. There are a lot of very cheap stocks in the consumer cyclical area that are cheap because the stock market has kind of discounted a recession in some respects.
What are you selling these days?
Well, I think we're tending to stay clear of the old inflation beneficiaries, the industries and the companies that really benefited from inflation in the late 70s, like the energy industry. We tend to have very modest positions in the oil and gas and energy industry.
We have an energetic panel to question you, starting with Frank Capiello.
Thank you, Lou. Dave, so much emphasis on Wall Street is on what to buy, very little on when to sell and how to sell. You're a savvy investor. Can you give us some clues or tips that you use on when to sell a stock?
Well, I think that what you try to do is probably use valuation methods to tell you when stocks should be sold. If you wait to get the fundamental news, you're probably too late. So you're trying to do relative valuation comparisons between stocks or between industries.
Where can I get a better bang for my buck?
Where do the valuation levels lead you?
Okay.
Dave, you and your firm manage a lot of portfolios, and I'm sure they're managed differently, but do you have any disciplines for portfolio management and any breakdowns in percentages as to how you're invested now?
Yes, we operate on the basis of themes or sector and policy guidelines built around that, and our principal guidelines today are to de-emphasize these inflation beneficiaries and keep very modest positions in those types of stocks. And our guidelines emphasize some of the areas that I've mentioned, where we are specifying overweighting in portfolios, like in the media industry or in some of these consumer cyclical areas.
Okay. Dave, you said a few minutes ago that you think inflation is coming way, way down, and the consumer price index, no question, is way, way down. But if that's true, why is it that every time we go out to buy a restaurant dinner or an automobile or a hotel room or a tie or anything else, it's way, way up in price over the year before? Is the CPI out of whack, or is everyone else out of whack?
I think you're just upgrading the quality of your purchases. I think the CPI is presenting a fairly accurate picture of what's going on. Car prices are only up 1% or 2% in the last year, as an example. I haven't priced ties lately, however.
Okay.
Dave, your words are soft, but your views are highly optimistic. We have a huge budget deficit. We have high interest rates. We have a yawning trade gap. We have a richly priced dollar. What do you think about those concerns?
Well, they're there, and there's some grounds for concern. The deficit is an annoying problem that I suspect is going to be with us for a while. I think we will see gradual progress made on reducing it, which gives you some hope that the bond market will take a little comfort and start discounting some good possibilities rather than negative possibilities. But I think we're all kind of holding our breath and crossing our fingers for post-election action on the deficit.
It is an election year, as you suggest. Does it matter who wins in terms of your investment philosophy?
I think it would be very helpful for the financial markets if we got a unified government, if we got a House, a Senate, and an executive branch that were all of the same party.
There are two ways that could happen.
Well, you can probably guess the way I would prefer. I think the Republicans would probably make a more credible attempt to deal with some of these financial problems. But I think the main thing is it would be wonderful if we could get a party responsible for what happened.
Dave, we only have a minute or so left. I know you deal in billions. Suppose I came to you with $10,000 and said, what should I do with it? What would you tell me?
Well, I've given you some wonderful stock ideas, but
what proportion should I put in those wonderful stock ideas?
Well, I'd say I'd be fairly aggressive in a portfolio right now, maybe 3/4 stocks, and I'd buy the balance 25% of the portfolio in aggressive bonds like zero coupon bonds.
Why do you prefer those zero coupons that pay no current interest?
Because they're the most volatile bonds, and I'm betting on a 1 or 2 year basis that interest rates are going to be declining. So I'd want to go for the volatility.
Is your interest rate forecast based on your inflation forecast?
I think at some point the bond market's got to pay attention to what's going on in inflation.
What's paralyzing the bond market now?
It's looking backwards. It's remembering how bad inflation's been. You know, bond prices peaked at the Battle of Midway. That's over 40 years ago. There are hardly anybody trading bonds today that knew that bonds could go up in price.
Now I understand the bond market for the first time in my life. Okay, I'm going to go to West Point for my advice in the future. Thanks very much, Dave Williams. Thanks, too, to our panelists. And I hope you'll be back with us again next week. We'll be holding our annual 4th of July party when we grill panelists instead of hamburgers. I'll review the economic news of the year so far, and then 4 of my panelists will offer highly specific suggestions on how to set off your own financial fireworks in the next 6 months. It should be quite a blast. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by this and other public television stations and by grants from the Hilton Hotels Corporation, America's business address, and its subsidiary, Conrad International Hotels, the world's business address. Prudential Bache Securities. Prudential Bache's total financial planning can help the American dream happen. And the Sperry Corporation. Computer-based information systems for business, industry, government, and defense. For a printed transcript of this program, send $2 to Transcripts. Wall Street Week, Owings Mills, Maryland, 21117. That's $2 to Transcripts. Wall Street Week, Owings Mills, Maryland, 21117. Maryland residents, please add 10-cent sales tax. Wall Street Week transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week is produced by the Maryland Center for Public Broadcasting, which is solely responsible for its content.
Channel 12's acquisition and transmission of Wall Street Week is made possible in part by a grant from the DuPont Company and by the members of Channel 12. Also made possible in part by a grant from the First Pennsylvania Bank, Trust and Investment Group. Laura Rendar will be sailing on that early bird vacation on the QE2, courtesy of Cunard Line. You too can win in our first Jubilee of Prizes, with 91 prizes awarded on July 4th. Be sure to return your tickets to WHYY by Monday. Meet the man who drove the Japanese out of Indochina, Tuesday at 9 p.m. Thursday night, Wilderness takes you for a trip into the darkest jungle of Brazil, a place they call the Green Hell of South America. It's a bustling world teeming with exotic and dangerous creatures, but one which is threatened with destruction by local developers and their attempts to turn the jungle into a giant ranch. Join us as we explore the past and future of the Mato Grosso of Brazil on Wilderness, Thursday at 8 p.m. Commercial jetliners. Since the early 1950s, they've been the only way to fly. But too often over the years, air travel has turned into havoc, with many innocent lives lost to human error and technical malfunctions. Thursday night, Glenn Ford looks at the safety record of commercial jetliners, the ongoing efforts to prevent tragedy, and asks, how safe is it to fly? That's Thursday night at 8:30 on When Havoc Struck. This is Channel 12. Good evening, it's 9 o'clock, movie time here on 12. Tonight we meet the young medical students of England who pursue each other as much as their medical degrees. Dirk Bogarde and Kenneth Moore star now in the hilarious comedy